Welcome back to the deep dive. Today, we're going to step away from the usual, the corporate world of the 401k,
Right.
and we're diving straight into the retirement plans that are really the backbone for public service. We're talking about the financial engine that supports our teachers, our city workers, hospital staff, nonprofit employees. The often, I think, very misunderstood 403b and 457 plans.
That's absolutely right. I think for a lot of people, especially if you're new to the public sector or the nonprofit world, you just look at these plans and think, okay, it's just a substitute for a 401k.
A different name for the same thing.
Exactly. But as we unpack the detailed source material you've shared, we find they're not just structurally unique. They have some really surprising flexibilities and, crucially, some very specific financial and legal risks.
And those risks are tied directly to who your employer is, which is a scary thought.
It is.
So our mission today, for you, the listener, is to give you the definitive checklist, but fast. We want to demystify these plans, lay out all the critical compliance quirks, and really highlight the advantages.
And the disadvantages.
And the severe disadvantages. We're looking at regulatory documents, IRS guidance, legislative history, all to get to the core of how these plans really work.
And, if we start at that 30,000-foot view, the high-level comparison, you do see a common ground.
Okay.
Both the 403b and the 457, they run on employee salary deferrals. You put money in pre-tax, it goes tax-deferred, and then you pull it out.
The core engine of retirement savings.
That's the one. And when you do finally take distributions in retirement, that money is typically taxed as ordinary income, just like a traditional IRA or 401k.
And both plans also have that same rule for when you have to start taking money out, right? The RMDs.
Yep. Thanks to some rule changes back in 2020, both plans are subject to required minimum distributions, or RMDs, starting at age 72. So that's the common ground.
But that's pretty much where it ends. The divergence in who can have them and how they're billed, it's immediate, and it's critical to understand.
It really is. The 403b, for instance, that's specifically for public education organizations, 501c3 nonprofits, cooperative hospitals, and even self-employed ministers.
Very specific slice of the workforce.
Very. And its tax treatment used to be, well, less flexible than a 401k, but that all changed after EGTRA.
The Economic Growth and Tax Relief Reconciliation Act of 2001.
That's the one. That act really brought the 403b's rules much more in line with the 401k structure we all know.
And then there's the 457, which you sometimes see offered right alongside a 403b for public employees. But it's a different animal.
A completely different animal. The 457 is what's called a non-qualified deferred compensation plan. It's for governmental employers, think state and local agencies, cities, public universities.
Isn't the important part.
And certain specific non-governmental employers. And that distinction, governmental versus non-governmental, that's the pivot point for our entire discussion today.
Because that one word changes everything about the security and the risk you're taking on.
Everything. Okay, let's unpack the 403b first. Let's see why its life is so different.
Absolutely. Let's start with the 403b. When people talk about this plan, you still hear its old name all the time, the tax-sheltered annuity, the TSA.
That name, that TSA moniker, it tells you everything about where this plan came from. Historically, the plan was restricted to just annuity investments, a fixed stream of payments.
But that's not true anymore, is it?
Not for decades. One of the surprising things our sources make clear is that since 1974, participants have been able to invest in mutual funds too.
But the name stuck.
The name stuck, and I think that habit of calling it a TSA, of seeing it just through that insurance product lens, it still persists.
So to be clear on eligibility, we're talking public education, 501c3s, hospitals, ministers. It's fundamentally built for a service-oriented workforce.
And that's what leads to the single biggest structural difference between a 403b and a 401k, and that's the ERISA question.
ERISA, the Employee Retirement Income Security Act of 1974. The big federal law meant to protect our retirement savings.
Exactly. But here's the key. 403b plans are not required to be what's called technically qualified plans under the tax code or governed by ERISA.
Hold on. How can a major retirement plan not be governed by the main law designed to protect retirement plans? That sounds like a huge security risk for the employee.
It sounds totally counterintuitive, right? But for the employer, especially a small nonprofit or a public school, it's a massive administrative gift.
How so?
If the 403b is not an ERISA plan, which is pretty common if the employer isn't making contributions, it gets to sidestep a lot of the really expensive technical hassles of a 401k.
Like what? What's the biggest one?
The biggest relief is getting rid of the complex non-discrimination testing for salary deferrals.
All right. So with 401ks, they have to run these intricate annual tests to prove the plan isn't just favoring the high earners. It's a huge headache for HR.
A massive burden. So instead of all that complex testing, 403Bs have something called the Universal Availability Standard.
And what does that mean?
It's much simpler. It just means that generally all employees have to be allowed to make salary deferral contributions as long as they meet some basic age and service rules. It's about broad access, not complex proportional testing.
And that simplicity must save these organizations a ton of money and time.
It absolutely does. That's why the 403B is so popular in these sectors. Non-ERISA 403Bs have way simpler and cheaper annual reporting. They file a simpler version of the IRS Form 5500.
And the big one.
And the big one, they get to avoid the super expensive, time-consuming independent auditor requirement that applies to most big 401ks with over 100 participants. That reduction in compliance burden, it's often the deciding factor.
Okay, let's pivot to the employee side. Let's talk about getting your money out. Like a 401k, the money is supposed to be for retirement, so it's locked up for a while.
That's right. If you're under age 59 and a half, you generally can't take an early withdrawal, not unless a specific triggering event happens.
And those events are things like,
Our sources always list the same ones: a proven financial hardship, a disability, or leaving your job separation from service. That's the firewall to keep the money in there.
but if one of those things does happen and you need the money, you're going to get hit with a pretty painful tax consequence.
That's the mandatory discouragement built right into the system. If you take an early withdrawal, first, the whole amount is taxed as ordinary income.
Okay.
And then on top of that, the IRS hits you with a mandatory 10% federal tax penalty. It ensures that even if you're taking it out for a hardship, there's a steep price to pay.
And, before we move on from this, I want to touch on a compliance detail that I thought was fascinating. The written plan requirement. It sounds like the IRS had to step in and force some organization on these plans.
Yes, this is a great look into how regulations evolve. Historically, a lot of these plans were super decentralized. You'd have an organization with multiple vendor contracts and no single unifying document.
Chaos.
Total chaos. So the IRS finally said, enough. They mandated that all plans must have a formal written plan document. On December 9, 2008, they gave sponsors a one-year reprise to get it done.
Why give them a year?
Well, it was an acknowledgement of just how messy it was. They knew it would be impossible for everyone to formalize decades of informal agreements overnight. But, and the sources stress this, even with the reprieve on the paperwork, the plan still had to operate in compliance with all the rules.
It was the government basically saying, it's time to professionalize this system.
Exactly. It had just gotten too loose.
That's a great summary. Now let's get into how the legal security of the 403B has fundamentally changed for the better. This is where it gets really interesting for me. The whole bankruptcy barrier before 2005.
This is so important because it explains why not having a ERISA status used to be this point of extreme vulnerability for employees.
So what was the rule before 2005?
Before the Bankruptcy Abuse Prevention and Consumer Protection Act, or BAPCPA, a non-ERISA 403B was generally not protected property. It wasn't something a debtor could claim as exempt.
So if a teacher in a non-ERISA plan declared bankruptcy, they could literally lose their entire retirement savings to creditors. That's terrifying.
It was a massive risk, and the legal landscape was a total mess. The safety of your savings depended entirely on the nitty-gritty details of how your employer set up the plan. The Inree Barnes case from 2001 just highlights this confusion perfectly.
Okay, walk us through that case. It sounds like a perfect example.
In Barnes, the person had a 403B account. The judge ruled that the money invested in a fixed income annuity could be seized by creditors.
Why?
Because it lacked the specific trust language and anti-alienation clauses needed for protection. But, get this, the variable account within the same plan was ruled to be protected under a different part of the code.
So depending on which sub-account your money was in, you could lose it all.
Precisely. It was a lottery. Back then, having that ERISA anti-alienation clause was the gold standard. It gave your assets the same kind of protection as a spendthrift trust, making them untouchable by creditors. This gap created a really unfair situation.
And Congress finally stepped in with BAPCPA in 2005 to fix it.
Yes. That 2005 reform was a landmark. It extended federal bankruptcy protection to 403Bs, to IRAs, to other retirement plans, shielding them from creditors.
Regardless of whether they were ERISA or not.
Exactly. It closed a huge security gap for public servants. It was a massive win for financial security in the nonprofit and education world.
That's incredibly reassuring. So today, you can pretty much assume your 403b has federal bankruptcy protection. Now let's talk about a more modern feature that really boosted its appeal, the Roth revolution.
The Roth option completely changed the tax planning game. Starting in 2006, 403b plans, just like 401ks, could add designated Roth accounts.
For anyone who might be less familiar, just explain that fundamental trade-off, traditional versus Roth.
Sure. With a traditional pre-tax contribution, you get your tax break today. You pay less tax now, but you pay ordinary income tax on everything when you withdraw it later. Roth is the opposite. You contribute with after-tax money, so you pay the tax today. But the huge benefit is that later on, withdrawals of both your contributions and all the earnings are 100% tax-free.
That must be a huge planning tool for people, especially if they think their tax bracket will be higher in retirement.
It's a game changer, as long as you meet the two big rules.
Which are?
The money has to have been in the plan for at least 5 taxable years, the 5-year rule, and you have to be at least 59 and a half. If you check those boxes, you have a guaranteed tax-free income stream in retirement.
Fantastic. Okay, one last niche case for this section.
Oh.
Church plans. They seem to operate in their own little world.
They really do. A church plan is defined as a retirement plan set up by a tax-exempt church or an association of churches for its employees. They exist outside the standard rulebook.
So what's their status when it comes to ERISA?
They are specifically not subject to ERISA, and they stay that way unless the organization makes a voluntary and, importantly, irrevocable election to be covered by it.
And because they're outside ERISA, what does that mean practically?
It means they avoid a ton of administrative work. They don't have to file the big annual IRS Form 5500. They don't have to distribute all those summary reports and plan descriptions to participants.
And a financial break, too.
A big one. If they have a defined benefit plan, they aren't required to pay termination insurance to the Pension Benefit Guarantee Corporation. It's a profoundly streamlined world that reflects their unique status.
Okay, that gives us a really comprehensive picture of the 403b. Let's shift gears completely now and talk about the 457 plan. This one operates with a totally different philosophy, especially when it comes to getting your money.
Right. If the 403b is for nonprofits and schools, the 457, this non-qualified deferred comp plan, is generally the tool for governmental employers, state agencies, cities, towns.
And there's an interesting group of people who can participate in a 457 that might not be able to in a 401k. Right?
Yes, this is a neat structural difference. Unlike 401ks and 403bs, a 457 plan, both the governmental and the non-governmental kind, can allow independent contractors to participate.
That's a nice little perk for governments that use a lot of contractors.
It is. But the single most attractive feature, the real aha moment for employees, is the withdrawal flexibility. This is what makes the governmental 457 so unique.
This is the big one.
This is the big one. A governmental 457 plan has no 10% penalty for withdrawal before the age of 55.
Which is just a radical difference from every other retirement plan out there, which mostly use that 59.5 rule. Why? Why does this one plan get this massive loophole?
It really goes back to its history. It was defined from the start as a non-qualified deferred compensation plan, not a fully qualified retirement trust like a 401k.
It's because it was built differently.
It inherited this massive flexibility benefit. It was designed to let government employees defer income without all the qualified plan rules, and this came along with it.
So just to be crystal clear, if a city employee leaves their job at age 52, they can start taking money from their 457 right away without that 10% penalty.
Exactly, which makes the governmental 457 an incredible tool for planning an early retirement. It's often called a bridge strategy.
A bridge to what?
A bridge to age 59 and a half. You use your 457 funds penalty-free to live on until your 401k or 403b money becomes accessible without penalty.
Now, what's the catch? Because there's always a catch. You avoid the penalty, but you don't avoid all the taxes.
That's the critical balance. The 10% penalty is waived, yes, but the entire withdrawal is still subject to ordinary income tax. So you're paying tax, but you're avoiding that punitive extra tax.
Which makes it a much, much better deal for an early withdrawal. And just like the 403b, the 457 also got the Roth treatment.
It did just a little bit later. The Small Business Jobs Act of 2010 allowed 457b plans to add Roth accounts starting January 1st, 2011. The mechanics are identical. Pay tax now for tax-free growth and withdrawals later.
Okay, now we get to the power section. This is where the governmental 457 really separates itself and lets public servants save at a rate that most corporate employees can only dream of. We're talking about stacking and catch-up provisions.
And this all comes down to one single piece of legislation. EGTRRA back in 2001. If you remember nothing else, remember how EGTRA completely changed the game for the governmental 457.
Before EGTRA, there was a major limit, wasn't there?
A huge constraint. Before then, if you were lucky enough to have access to both a 457 plan and a 401k or 403b, which is common at big public universities, for instance, your contribution limits had to be coordinated.
Meaning you had one maximum amount and you had to split it between the two accounts. You couldn't max out both.
That's right. You were stuck with one single maximum deferral. It really limited how much people could save.
But EGTRA 2001 came along and got rid of that coordination limit, but only for governmental 457 plans, and that created the famous double dip.
That is the pivotal insight. After that, a government employee could contribute the maximum elective deferral to their 401k or 403b and a completely separate maximum amount into their governmental 457.
So using the 2021 limits from our sources, that would mean $19,500 into your 403b and then another $19,500 into your 457.
A total of $39,000 in pre-tax deferrals. You instantly double your savings capacity.
That is an incredible amount of financial leverage.
It truly is. Now, there's one little nuance. Your 401k and 403b limits are still coordinated with each other. You can't max out both of those.
Right.
The 457 is the distinct account that you get to stack on top.
And now we get to layer the catch-up provisions on top of this. And the 457 world has two very different types of catch-ups. Let's start with the first one.
Type 1 is the one we're all familiar with. It's the age 50 catch-up, an extra amount, $6,500 in the 2021 example. That's similar to a 401k. But the key here is that this is only available under governmental 457 plans.
So if you're over 50 and you work for the state, you can put that age 50 catch-up into both your 403b and your governmental 457.
No, you can use an age 50 catch-up in your 403b and another one in your 457. It's fantastic. But then you have catch-up type 2.
The complex one.
The complex one. This is available in both governmental and non-governmental plans, and it's for employees who are within 3 years of their normal retirement age.
And how is this one different?
It's designed to be a massive final push. The potential contribution is equal to the full employee deferral limit, so another $19,500 using those 2021 figures.
But there's a big string attached. It depends on your history.
A huge string. This catch-up is strictly limited to your unused deferral limits from previous years.
So if you've been maxing out your 457 every single year you've worked there,
you can't use this feature. It's gone. It's designed for people who were late savers or who couldn't afford to max out earlier in their career. It's one last chance to catch up in a big way.
That is a powerful tool for late career savers. So let's put it all together. Let's talk about the maximum theoretical potential here.
Right. So imagine you're over 50, you're within 3 years of retirement, you have access to both plans, and you have that unused deferral capacity in your 457.
You can layer everything on top of each other.
Everything. So on the 401k or 403b side, you have your elective maximum, $19,500, plus your age 50 catch-up, another $6,500. So that's $26,000 right there.
Okay, $26,000 on one side.
Now, on the 457 side, you get your standard elective maximum of $19,500, plus the full potential of that type 2 catch-up, which is another $19,500.
So that's $39,000 on the 457 side?
Exactly. Add the $26,000 from the 401k, and you're at a potential deferral of $65,000 in a single year.
$65,000. It's a completely different level of savings.
It transforms your retirement runway. It's a level of financial leverage that's pretty much uniquely available to certain government employees.
An unmatched tool.
A powerhouse.
Okay, now we need to pump the brakes. We've just praised the governmental 457, but now we get to what I think is the most critical part of this entire deep dive.
The Great Divide.
The Great Divide. This is where we separate the golden rules of the governmental plan from the severe restrictions and, frankly, the massive risks of the non-governmental 457. This is the major caution point for you, the listener.
And it's fascinating how the entire regulatory structure treats risk and security based on one thing: your employer's tax status. Let's start with the governmental 457 again, the flexible one.
In terms of moving your money around, how portable is it?
Extremely. Governmental 457s are generally treated like other qualified plans for mobility. You can roll them into 401k, 403bs, and IRAs with very few restrictions once you leave your job.
And why is that so important for an employee?
Because it lets you consolidate your savings later in life. It lets you take advantage of better investment options in an IRA. It means the money is truly yours and it can follow you. It's secure, it's portable, it's protected.
Okay. Now for the dark side. The non-governmental 457 plan. These are the ones offered by large nonprofits, some hospital groups.
This is where you need to see the big red flashing warning sign. The first restriction is the rollover limitation. It's severe.
What is it?
Money in a non-governmental 457 plan can only be rolled into another non-governmental 457 plan. You cannot, under any circumstances, roll it to a 401k, a 403b, or an IRA.
So your money is captive. If you leave that job and go to a regular corporation, those savings are just stuck.
They are stuck, but that's not even the biggest risk. The biggest risk is asset protection, or rather, the complete lack of it.
What do you mean?
Funds in a non-governmental 457 plan are not set aside in a trust for the exclusive benefit of the employee.
Hold on. I, as an employee, defer my salary. I take home less money in my paycheck.
Yeah.
But that money doesn't legally belong to me.
Not in the way you think. The Internal Revenue Code requires that money to remain the legal property of the employer. It's a liability on their balance sheet, like any other debt they owe.
Why on earth would it be structured that way? It puts all the risk on the employee.
Because that's the only thing that makes the tax deferral work. If the funds were put in a separate account just for you, the IRS would say you've constructively received them, and you'd have to pay tax on the whole amount immediately. The tax deferral only works because the money is still technically the employer's.
Which brings up the existential question.
Yeah.
What happens if my nonprofit employer goes bankrupt?
This is the moment the risk becomes real. Those funds are available to the employer's general creditors. You, the employee with your life savings in that plan, are just another unsecured junior creditor.
You could lose everything.
You could lose everything.
So the governmental 457 is secure and portable. The non-governmental 457 is basically a high-stakes, unsecured IOU from your employer.
That's the perfect way to put it. Its value depends entirely on the long-term financial health of your employer. It is nothing like the ironclad protection of a 401k or 403b trust.
Now, let's talk about the specific type of this plan, the 457B. It gets a nickname, right? A top hat plan. Who is this high-risk vehicle for?
This is where ERISA actually comes back into the picture, but in a restrictive way. ERISA says these non-governmental 457B plans must be limited to a select group of more highly compensated employees.
So this isn't for everyone, like a 403B?
Not at all. It's exclusively for executives or key people. The sources suggest that the compensation limits used for 401k testing, in the low six figures, would probably be an acceptable standard.
Hence the nickname Top Hat. It's for the top brass.
Exactly. The thinking is that executives are in a better position to understand the heightened risk and to assess their organization's financial health.
Okay, let's move to the most complex and maybe the riskiest version of all, the 457F structure. This sounds like financial engineering at its most extreme.
The 457F plan exists because these nonprofits are limited in what they can offer. This is their alternative, a way to attract and retain top talent with big compensation packages.
What's the main appeal for the executive who would use a 457F?
Two things. First, it's tax deferred. And second, and this is crucial, it can exceed the normal annual contribution limits. It's for those highly paid executives who have already maxed out everything else.
So if an employer is deferring a huge amount of money, way over the limit, what's the mechanism that makes the tax deferral legal?
It's a heavy-handed mechanism called the substantial risk of forfeiture, the SRF. This is the central high-stakes gamble of the whole plan.
Okay, what does substantial risk of forfeiture mean in plain English?
It means you have to face a real possibility of losing all the money. The IRS says this requires two things. First, the money has to remain available to the organization's creditors.
Same old solvency risk.
Same old risk. And second, it must be subject to a strict vesting schedule.
So you have to stay with the company for a certain number of years or you lose it all.
Absolutely. If you leave before you're fully vested, the money is forfeited. It goes back to the organization. It's the ultimate golden handcuffs.
That's a brutal mechanism. So what happens when you finally do vest after, say, 5 or 7 years?
This is the really dramatic part. The second that risk of forfeiture is gone, the moment you vest, the entire value of everything that's been deferred is immediately included in your ordinary income for that year.
The whole pile of money becomes taxable at once.
All at once. The tax deferral just stops. It can create a massive, sudden spike in your income, and it demands incredibly careful tax planning to handle it.
So how do organizations give the employee some security to make sure the employer doesn't just change its mind while still meeting that IRS risk requirement?
They use something called a rabbi trust. It's a structure where the deferred money is put into a trust overseen by a third-party trustee. It feels safer because the money is physically set aside.
But there has to be a catch, right, to maintain that risk.
There is. To avoid immediate taxation, the funds in that rabbi trust must remain available to the employer's general creditors in case of bankruptcy.
So the rabbi trust protects you from your employer changing their mind, but it offers zero protection if the employer goes under.
That is the perfect summary. It's security against corporate whim, not corporate failure. You're still an unsecured creditor.
And finally, we have to look at the legislative context here, Section 409A. This came directly out of some of the biggest corporate scandals we've ever seen.
Section 409A was passed in 2004, and it was a direct reaction to the kind of executive behavior we saw at places like Enron and WorldCom.
What exactly were the executives at Enron doing that Congress wanted to stop?
Well, their bonus plans had these trigger clauses. These clauses allowed key executives to get immediate early access to all their deferred compensation if the company's financials started to look shaky.
So they could cash out right before the company collapsed, leaving everyone else with nothing.
A textbook case of self-dealing. They could pull their millions out and leave the creditors and regular employees holding an empty bag. Section 409A put a stop to that by creating strict rules about when deferred comp can be paid out.
It prevents executives from using these plans as an emergency escape hatch from a sinking ship.
Exactly, and that context is so important for understanding why these plans have such specific and sometimes harsh rules today. It's a constant balancing act.
Okay, let's bring this all home. Let's summarize the key takeaways for you, the listener, after this deep dive into the world beyond the 401k.
First, the 403B. It's for nonprofits and schools. Its big advantage is administrative simplicity, thanks to that non-ERISA status and the universal availability rule. Structurally, it's very safe, like a 401k, especially after it got federal bankruptcy protection in 2005.
Second, the governmental 457 plan. This is your strategic powerhouse. It has two huge advantages: that unique pre-55 penalty-free withdrawal option and the ability to double dip on deferral limits, letting you save massive amounts of money, maybe over $65,000 a year, as you near retirement.
Third, and this is the big warning, be intensely wary of non-governmental 457 plans, the Top Hat plans. They are an unsecured liability. The funds legally belong to your employer. Your savings are captive, and they are totally subject to your employer's long-term solvency. It is a financial IOU.
And fourth, the 457 plans. They are the ultimate high-wire act. They use that substantial risk of forfeiture tied to a vesting schedule to defer taxes. And when you vest, you pay tax on the entire amount all at once. Even with a rabbi trust, the money is never safe from the employer's creditors.
This whole journey just shows how profoundly the legal context, ERISA, bankruptcy reform, EGTRA, has shaped these plans. The legal classification literally dictates whether your retirement savings are a secure asset or just an unsecured promise.
So as we close, let's leave you with this final provocative thought to consider. We saw how the 2005 bankruptcy reform closed the security gap for the 403B, making it safe. But given that these non-governmental plans fundamentally rely on your employer not going bankrupt with the funds technically remaining their property, what is the true long-term cost of that tax deferral? And how might a future law change the game again, maybe altering vesting rules or even requiring some asset protection? It's something to ponder as you look at your own retirement options and the financial health of the entity that signs your paycheck.
A fascinating and critical part of financial planning that really demands your attention.
Thank you for joining us for this deep dive. We hope you feel thoroughly informed and maybe a little more prepared to assess the true risk in your own retirement portfolio.